Good evening. It is Monday, 9:30. Let me start that again. Good evening. It is Monday, April 16th, 9:30. People, my voice is getting better. My microphone is not. I picked up a new microphone today. I'm talking into it as close as possible. I'm going to return it. I should be getting my old one back soon. So in the meantime, I'm just trying to make do. So thank you for your patience. I have some important things to talk about tonight, though. A couple of the Fed heads got together, had some Fed speak today. I find it very interesting, very telling. Neil Kashikari. Minneapolis Federal Reserve President Neil Kashikari said recent steps by the federal government to stimulate economic growth, including tax cuts, make reaching a 2% inflation objective more likely. So he feels they're going to hit that 2%. That means the Fed can most likely move ahead with additional planned interest rate hikes this year. He said in an interview with the Wall Street Journal published early Monday. Kashikari voted against all three rate hikes approved by the central bank last year. He was one of the dissenters, this guy, and I think for good reason. When he had his turn on the rotationary policy setting panel, he cited persistent, tame inflation at that time. Congress and the White House approved tax cuts last December and federal spending increases in February that are macroeconomically significant, and they are big enough to have an effect on the trajectory of the economy that could change things in a meaningful way. Kashikari told the Journal. I doubt that, but nevertheless. The Fed raised rates again last month, bringing the range between 1.5% and 1.75%. That's the Fed funds target rate. And continued to signal 2 more increases this year. Kashikari would not say what exact number of hikes he expects in 2018. It isn't going to be obvious to me once we achieve our inflation target that we need to now put the brakes on the economy. But I would argue once we achieve our inflation target, we should try to get to neutral in a reasonable period of time, he said in the interview, adding that bank policy might already be close. We might be 1 hike away from achieving neutral, he said. And that's that neutral rate that we've been talking about for a long time. And he's saying they might only be 1 hike away from achieving neutral. So are they going to be 1 more and done? I don't know. They don't know. They're flying by the seat of their pants, to be honest. They really are. But based on that last sentence, they might be 1 hike away from neutral. Now, they're already 1.5% to 1.75% Fed funds rate. And as they continue to raise rates, this yield curve is flattening like a pancake. And I want to get into that. There's no more room on the upside. There really isn't. Then we have Robert Kaplan, Dallas Fed Reserve Bank president. If you remember Kaplan, he was the one that didn't want to overshoot on unemployment. You know, if it's too hot, we can't have everybody working. That was Kaplan, if you remember. I said he should be the first to go. If it got under 4%, okay, the unemployment rate, He's got a problem with that. We'd be overheating. I said, well, then let him lose his job to get it back to 4%. Let him be the first to go. This arrogant, let me not go there. Dallas Federal Reserve Bank President Robert Kaplan on Monday said he expects the U.S. Central Bank to raise interest rates 3 times this year. This is what they do, people. They come out before the Fed meeting, and by the way, the next Fed meeting is May 1st and May 2nd. Okay, it's right around the corner. They come out, they give all this double speak. Oh, we can raise, maybe we will 3 times, 1 more, to give this impression that there's this intelligent debate going on, and there's not. He expects central banks to raise interest rates 3 times this year and further next year to levels that could put the brakes on U.S. economic growth, but that he does not want to push short-term rates above long-term borrowing costs, and they're practically there already. And I have a chart, and I want to get into that. If he doesn't want to push the short-term rates, above long-term borrowing costs, then how is he coming up with 3 this year? This guy's got to go back to grade school and just take basic algebra. I don't have a problem with being restrictive, Kaplan said, adding that monetary policy would be restrictive if interest rates rise above the 2.5% or 2.75% that he estimates is their neutral level. Okay, so he says the neutral level is between 2.5 and 2.75. Cash and Carry just says we might be 1 hike away from neutral. They don't even know what's neutral. You can't hit a moving target, okay? How these guys have any credibility left is a complete mystery to me. But he said he would not want rate hikes to proceed so fast or so far, excuse me, that the yield curve inverts, practically there. The yield on the 10-year Treasury, currently around 2.85%, rises higher, acts to limit the pace and the slope of how fast we can raise rates. All right, so we have the usual suspects coming out with their doublespeak. But this neutral rate is very important because I feel, personally, they don't have many more hikes in them. And gold is holding up extraordinarily well underneath the circumstances. Now, next thing I want to mention, President Donald Trump accused China and Russia of devaluing their currencies, opening a new front in his argument that foreign governments are taking advantage of the U.S. economy to support their own expansions. Another front. The trade war, is it on? Is it off? It's not going away, people. Just 3 days after the U.S. Treasury ruled no country is manipulating its exchange rate, Trump took to Twitter to declare that China and Russia are playing what he called a currency devaluation game at a time when the U.S. Federal Reserve is raising interest rates. Not acceptable, Trump wrote. The attack adds fuel to the brewing trade dispute between the U.S. and China, while also targeting Russia, which the White House recently imposed sanctions on and clashed with over Syria. Trump has repeatedly blasted Beijing for failing to reduce its trade surplus and open its markets to American investment. China's yuan, though, has gained about 10% against the dollar over the past 12 months, climbing in March to the strongest level since August 2015. So how are they devaluing their currency? The yuan is strengthening against the dollar. The dollar has been going down. Recently, it's been consolidating, but it's had a terrible start to 2018. This whole thing is breaking down, people. We are at a perfect storm right now. The JOLTS report the other day, job openings contracted in a big way. Um, it's just all coming. It's coming unglued, people. It really is. Got a couple of more articles I want to get to, and then I want to get to some charts. Jim Rogers, legendary investor Jim Rogers. This was on Kitco News. Legendary investor Jim Rogers says market participants should enjoy the rally in stocks while it lasts, issuing a dire warning that the worst correction of his lifetime is coming. Soon something's going to happen that will make everyone happy again, and the market will go up one more time, and that will probably be the last hurrah. I think the last hurrah is already here. Next year will not be a lot of fun, Rogers said in an interview with Kitco News on Monday. I don't think this year is going to be much fun either, as far as stocks go. He added, it's been 10 years since we have had a bear market. That is very, very unusual. So the next bear market is going to be the worst in my lifetime. Now, there's a lot of things about this guy I don't necessarily agree with. Nevertheless, I mean, he's warning that, I mean, it's going to be the worst bear market in his lifetime, and he's 75 years old, and he's seen some bear markets, I'm sure. When promoted to quantify the correction, Rogers said it would easily be over 50%, 50% correction. Turning to gold, last Wednesday, the metal reached its highest level since last August 2016, as jitters grew over Syria and Russia. Now, I had said, I think when my last video might have been yesterday, actually, and I said, you know, unless this is a case of buy the rumor, sell the news, meaning Syria, you know, they have these jitters before anything was fired off. That's buying the rumor. And now they think it's all over and there's peace in the world again and everything is breaking out wonderfully, and that's selling the news? I don't think so. Many analysts expected the metal to start the week strong, given the geopolitical tensions. Yet gold prices were trading near unchanged in early U.S. dealings Monday. When there's a lot of bad news and something like gold doesn't go up, it means it's not going to go up. The correction is not over for gold, Rogers explained. Now, he's been saying this for quite a few years now. He's digging his heels in, and he still expects gold to go to 1,000. If gold goes to 1,000, I hope I am smart enough to buy a lot. He's always self-deprecating. I hope I'm smart enough. I hope I'm smart enough. Maybe he's not smart enough, okay? Maybe he's just not smart enough. If gold goes to 1,000, I hope I'm smart enough to buy a lot of it. Because before this is over, gold is going to go through the roof. When people lose confidence in governments and paper money, they always buy gold and silver. Whether they should is irrelevant. They always have. Rogers, the 75-year-old chairman of Rogers Holding Inc. said. So he long term, he does like gold. He says it's going through the roof. He's just digging his heels in and still feels we have to go to 1,000. He has said that several times. I don't know why he's so adamant about it, but I think he's wrong. And he says over and over again he's not smart enough. He's not a trader. So I'm going to take him at his word. He's not smart enough because I believe the bottom's in. And I don't think we're never going to get anywhere close to 1,000 again. So let's turn our attention to a couple of charts. The first is this Atlanta GDP now. Now, this as of April 16th, the GDP now estimate first quarter 2018 is down to 1.9%. Now, I said the last time that I spoke about Atlanta GDP now that we could go below 2%, and we did. Now, we could go back up it a little more, okay, but it's 1.9% as of today. And the next update is tomorrow. So they started out at 5.4, They're down to 1.9. And there's not many more economic releases left that are going to affect this number. We had the retail sales today, and it bounced, okay, mostly due to auto sales. And I'm wondering, perhaps this is the people that got their tax checks already, and they went out and spent it. So I'm not convinced that this number today is the start of a trend. I think it might just be a one and done. So you have retail sales April 16th today. Tomorrow you have housing starts, industrial production, capacity utilization. That's tomorrow the 17th. You have durable goods April 26th, and you have personal income and outlays April 30th. But that isn't even going to be part of first quarter GDP. 1.9%. Now, I want to talk about this yield curve a little. Because today, the 2-year reached a high 2.38. That's the highest it's been in 10 years. The difference between 2s and 30s is 0.64. 0.64. So if they raise the short end 1, maybe 2 more times, this yield curve could invert easily. The difference between 5s and 30s, 0.34. You can see that? This thing is flattening and flattening. Now they're going to tell you because the economy is doing well. That's why interest rates are rising. The shills and cheerleaders on CNBC. No, that's not why. Because they're raising the short end, okay? And the 30-year hasn't been going up. There's no inflation, according to their models. In any event, this thing is ready to invert, and that's a sure sign of a recession on the horizon. So that's all I wanted to talk about today, except to say one more time, I'm loving the action in gold. I believe last week was a game changer. Wednesday, it had that big $25 move up. They banged it down. The next day, Thursday, they could not take it below 1340. Friday, stayed above 1340. Today, a lot of people are disappointed in the price action because they expected a bigger move, right, coming off what had happened with Syria. All right. I'm not fazed by it. I was kind of expecting what we got today. This buy the rumor, sell the news type of thing. Okay. So, but I don't have a problem with today's action. We are right on the cusp of breaking out. You've seen the charts. I mean, it's clear as day now. It's just a matter of time. The bears are, this is their last stand as far as I'm concerned. So we just have to watch it, and we just have to hang on, because I believe we're knocking on the door. So that's it, people. Hopefully, Lord willing, I can get some more of these videos out. Hopefully the sound will improve. I can't wait to get my old microphone back. So that's about it for now. Thank you for listening, and stay the course, people. Ciao.